In this chapter, we're going to talk about the security markets and how securities are treated in the security markets. We'll first look at how firms issue securities. In this chapter, when we talk about financial markets, we talk about the primary and secondary markets. Primary markets is for the sale of new securities issued by the corporation. So the shares will never exist before. It could be the very first time a private company issue new shares. After the shares are issued, the private company becomes public traded company. The same company may want to issue more new shares in the following years. Those shares are also issued in the primary markets. Once the new shares are issued in the primary markets, they will be traded in the secondary market. So in the secondary market, previously issued securities are traded among investors. In this chapter, we're going to talk about the security markets and how security. In this picture, we show you how the primary markets and secondary market work. We start from the firms. Whenever the firms need to raise money from the general public, they can issue new shares of stocks and bonds. New shares means the shares never exist in the market before. So for the very first time, the firm issue those new shares. Okay? It happens in the primary market. So when the firms issue new shares of stocks and bonds in the primary market, in return, they will get money from the investors, while the investors in the primary markets provide money to the firms. In return, they get shares of stocks and bonds. Once the new shares are issued in the primary market, they are traded in the secondary market by individual investors like Bob and Sue. They can buy and sell the stocks. So the difference here is the firms, the issuing firms, are only involved in the primary market. In the primary market, they sell the new shares and get the money, and that's it. Then the shares will be traded in the secondary market. In the secondary market, the issuing firms are not really involved. Only the individual investors or institutional investors are trading the shares among themselves. So if the stock price increase or drop in the secondary market, it has nothing to do with the firms, with the issuing firms anymore. Here, primary markets, really the market for the new issues or the new shares are created and sold. So the key factor here is the issuer will receive the proceeds from the sale. We have two types of offerings in primary market. The first one is called public offering, means the new shares can be sold to general public. It requires the registration with the SEC. The second type is called private offerings, means instead of selling it to the general public, new shares are sold only to a very limited numbers of investors with restrictions on resale. Most of the time, they will talk to just a couple of big institutional investors and sell the shares privately. The benefit is they don't need to register with the SEC and save a lot of paperwork. In the secondary markets, means after the new shares are injected in the market, in the primary markets, now the existing owners can sell to another party. So the issuing firm will not get any proceeds from the sales and is not directly involved in the secondary markets. For the common stocks in the primary markets, we're really talking about two different offerings. The first one is called IPOs. The initial public offering means the very first time the firm issue any new shares. It happens when the private firms go public for the very first time. and sell the stock to the public for the very first time. For example, a startup software company. It was private before, and then in this year it's getting ready and want to have the access to the general public for fundings. So IPO means for the very first time the company issue new shares. After the IPO, the private company becomes a public traded company. The second type is called seasoned equity offerings, means new shares are issued by the already public traded companies. Now back to our startup company, software companies. After the IPO, the private company becomes a public traded company. After a couple of years, this public traded software company needs more money to a new project. So the company can issue additional more new shares. Here the new shares means the shares never existed before. For example, in IPO, if they sold 1,000 shares, means in the market there will be 1,000 shares outstanding. A couple of years later, the firm can issue more new shares, say 500 shares. Okay, a couple of years later, the company wants to issue 500 shares more. Those 500 shares are completely new, not available previously. So these 500 shares of new stocks are called seasoned equity offerings, means they are new shares, but not the first time IPO. Okay, means in the public traded companies, the first time they issue stocks are called IPOs. Then all the subsequent new stock offerings are all called seasoned equity offerings. In the bond market, we also have public offerings and private placements, just like the stock markets. For the public offerings, the bond will be sold to the general public and can be traded on the secondary market. While for the private placement means instead of selling the bonds to the general public, the bond is sold to a few institutional investors, and those institutional investors most of the time will hold it until the maturity instead of trading them on the secondary market. Now we talk about how firms issue securities. We first talk about privately held companies. If the company is not a public traded company, privately held company, well, the maximum shareholders it can have is 499, means you cannot have more than 500 shareholders. Well, because they are private companies, so they have very few obligations to release the financial statements to the public because they are private companies. How will private companies issue shares? They can issue shares through the private placements. Primary offerings sold directly to a small group of investors. So instead of selling the shares to general public, they can still talk to a few individual or institutional investors to sell their shares. Now, when public traded companies issue new shares, they can issue the shares to the general public. That's the purpose of getting public traded company, right? Because you have the access to the general public for investment fundings. It allows investors to trade shares in security markets. Once you sell the shares becomes outstanding shares in the market. Individual or institutional investors can trade among themselves. Initial public offerings, which is the first sale of the stock by a formerly private companies, most of the time will hire underwriters, the big investment bankers. So the underwriters or the big investment banks will purchase the securities from the issuing company directly and then resell them, like most of the time. That is why IPOs most of the time will hire investment banks to help them to sell the shares for the first time to the general publics. The prospectus is the description of form and securities being issued. When issuing forms hire investment banks as the underwriters, sometimes they will hire underwriting syndicate, means instead of hiring just one investment bank, they will hire a group of them. So they will have a lead underwriter, which is the lead investment bank. And then under the lead underwriter, they have a group of cooperating banks, investment bank A, B, C, D, or even more. Together, they help the issuing firms to sell the new shares to the private investors. A special way of issuing securities is called shelf registration. Under the SEC Rule 415, the securities is pre-registered and then may be offered at any time within the next 2 years with a 24 hours notice. Okay, why we have this shelf registration? Whenever the firms want to sell the shares, it will go through a lot of paperwork, registration, and preparation. And sometimes when the firms want to issue the securities, the market is very good. The share price is pretty high and they can sell the shares for a very, very good price. But after months of preparation of the paperwork and registration, the economy may going downward. So now the shares are selling at a very low price. At this time, when you want to issue the new shares, you have to sell the new shares at a relatively low price. So to avoid the risk of this type of thing happens, some companies want to have the shelf registration. Think about the shelf, just like the bookshelves. So you do the registration and the paperwork before you actually issuing the shares. Once you get the paperwork and registrations, you can just put them in your bookshelves. You can think that way, right? That is why it's called shelf registration. Once you have all the paperwork ready on your bookshelf, you can actually time the market. You can wait in the next 2 years. Whenever the market is up, the shares price are very high, you can time it. Pick a good timing to sell your new shares. As long as you give 24 hours notice, then the new shares can be offered. So a lot of the company want to take advantage of the shelf registration because it gives you a better chance to sell the new shares at a better price. This shelf registration is introduced in 1982. Now let's take a look at the initial public offerings, the procedures. First of all, the issuers and the bankers will put on roadshow. The purpose of the roadshow is book building and pricing. So basically, the investment bankers will go to the potential buyers and introduce the new company and the new shares. Then they will ask the potential buyers, at what price level, how many shares are you planning to buy? Most investors would like to purchase the IPO price because they know most of the time the IPO price is underpriced. So why there is an underpricing? Now suppose the fair market price per share is $100, which means the investment bankers will purchase at $100 per share from the issuing company, and then they will resell all the shares to other investors. To make a safe cushion, the investment bankers, instead of setting the price at $100, they want to sell it at a lower price, say $90, to make sure later on they have no trouble to sell the shares, all the shares to the general publics. Well, this is very convenient to the investment bankers and it's very safe to the investment bankers, but to the issuing firms, this is very costly because upfront you can see you can sell it for $100, but investment bankers are only going to give you a price of $80 or $90. You're losing money upfront. So we can see from here, underpricing means the post-initial sales return is very positive, on average 10+% return right after the IPO. Because of the underpricing, people know the IPO price is completely underpriced. So the return is very positive right after the IPO days. But there is a winner's curse problem. The long-term performance of the IPO stocks are rather poor. In this picture, we show the average first-day return for the US and European IPOs. So we gather all the IPO companies' information and calculated the average right after the IPO, the very first day returns. Let's take a look at the US first, which is in the middle. So on the first day of the IPO, the average return in the US is around 18%. The highest country is Sweden. On the very first day of the IPO, the average return is about 30%. Even in the lowest one, Russia, the very first day after the IPO, the average return is still around 7 or 8%. So it really shows the IPO price is underpriced. That is why we have seen this significant positive post-IPO returns. In this picture, we show the average first-day return for non-European IPOs. We can see the returns are even higher. We look at China first. If you purchase IPO stocks on average, first-day return is about 160% in China, which means if you're lucky enough to purchase an IPO, on average, your very first-day return will be 160%. Even if we look at the lowest country, Argentina, you still have about 8% return on the very first day after the IPOs. And again, those are the average numbers across all IPO firms in each individual country. Now we move on to the next section, how securities are traded. So first of all, let's talk about different types of secondary market. The first one is called direct search, means buyers and sellers will seek each other out directly. So the trade will be directly done by the two counterparties, just like you sell your used TVs in Craigslist or you sell your used second-hand textbooks to your classmates. Well, in stock markets, it's more like if you own 10 shares of Google stocks, and you want to ask your friends and your classmates and say, hey, I want to sell my 10 shares of stocks. Who wants to buy it from me? If your classmate or your friends want to buy directly from you, that is a direct search and a direct trade. Well, it is pretty hard to find the buyers and the sellers all by yourself in the direct search. So that is why we have a second type of secondary market, which is called brokered market. So here we have a broker. So the broker will offer the search services to both buyers and sellers. Here we have some examples. The first example, recall the real estate market realtors, the agents. When you want to buy a house or you want to sell a house, most of the time you will hire an agent, a broker to help you instead of buying and selling the house all by yourself. So the broker or the agent will show you all the houses in the area and then you can pick the one you like. Well, after the transaction, after you purchase the house or after you sell the house, you will pay a commission, a percentage of the price of the house as commission to the broker. The second example is in the primary market, firms hire investment bankers to help them to sell the shares. Okay, so the investment bankers can play the role of brokers as well. So the investment bankers help the issuing firms to find potential buyers. So the next type of the secondary market is called the dealer's market. A good example is Nasdaq. So what is the difference between broker and a dealer? Well, in broker market, a broker helps the buyers to fund the sellers, helps the sellers to fund the buyers. Only when the deal is done, they get paid. So the broker will just help you facilitate the trades, but they do not directly purchase or sell anything from their own account. While the dealer is different. The dealer will actually buy and sell from their own account. So let me give you an example. Now suppose you have one share of Amazon and you want to sell it. In the broker market, you will call your broker and say, hey, I have one share of Amazon. Try to find me someone who is willing to buy from me. The broker will help you to find a potential buyer, and hopefully the deal can go through. Then the broker will be paid. If the deal did not go through, the potential buyer and you cannot have agreed a price, the broker will not get paid at all. So you still keep your share and you don't sell it to anyone. Well, in the dealer's market, it's different. If you have this one share of Amazon stock, you want to sell it, you can sell directly to the dealer. The dealer will buy from you directly, say at $3,000. So you sell your share of Amazon stock to the dealer. The dealer pays you directly $3,000. Later on, the dealer will find himself a buyer of the Amazon stock. Then the dealer will sell your Amazon stock to someone else at a higher price, say $3,100. So the difference between the $3,000 the dealer paid you and the $3,100 collected from another guy, this $100 difference is the profit for the dealer, and this is called the bid-ask spread. So what is bid-ask spread at all? Well, to understand that, we have to talk about the bid price and ask price. So first of all, both prices are from the perspective of the dealers, okay, not from the investors. The bids are the offers to buy, while the asked price represent the offers to sell, which means in the dealer's market, the bid price is the price at which the dealer is willing to buy. So here, pay attention. Bid price is the price at which the dealer is willing to buy, which means for the investors, the bid price is the price you get when you sell the securities to the dealers. Or for the asked price in the dealer's market, that is the price at which the dealer is willing to sell. Again, the definition is from the dealer's perspective. Okay, so the dealer is willing to sell. That is the price called asked price. From the investor's perspective, it means you have to pay the asked price to buy the securities from the dealers. So the bid-ask spread is the profit for making a market in a security. So the asked price is always going to be higher than the bid price because the dealers will have to make a profit. So now let's take a look at the dealer's market in foreign exchange. Now we have two companies, one UK company and one US company. The UK company has British pounds, but they want to do trade in the US, so they need US dollar. The US company wants to do trade in UK, and they have US dollar and need British pounds. Ideally, the two companies can trade between themselves, but they don't know each other because they are located so far away. So what they can do is they can get some help from the dealers. So the US customers can purchase the British pounds from a local dealer. The UK customer can call the local UK dealer and purchase the US dollar to satisfy their needs for international trades. And then the dealers can trade among themselves for British pounds and US dollars. And sometimes the dealers will need some help from other people, say broker, because the dealers are local dealers one is located in the UK and the other is located in the US, it's very hard for them to find each other. So maybe they can need some help from the brokers. The brokers will help to find the two dealers and make the trade happen. So in this transaction, the dealers make profits from the bid-ask spread. The broker makes the profits from commission. So when the trade is actually done, the broker will get a percentage as commission. The last type of secondary market is called auction market. This is the most integrated market. New York Stock Exchange is one good example of the auction market. So in the auction market, all traders will converge at one place to buy and sell an asset. So the advantage of the auction market over the dealer market is there is no need to search across different dealers to find the best price for a good because everything is integrated in this one market. You can save the bid-ask spread. When you want to buy or sell stocks, you can place different orders. The first one is market order, which is very simple. When you make a market order, the order will be executed immediately at the best price in the market. For example, if you want to buy one share of Amazon stock, you place the buy market order. You don't really know exactly how much you're going to pay for the Amazon stock because it depends on the moment when you place the order, what is the best available price some other investors are willing to sell to you. Okay? All right. If you have a specific price in mind, you want to place a price contingent order. For example, you want to buy Amazon stock at $2,500 per share. Well, you can place a market contingent order. You just tap $2,500, buy whenever the stock price hit $2,500. If the current market price is around $3,000, once you place this price contingent order, the order will not be executed immediately because the current price is $3,000, but you are only willing to buy at $2,500. No one is going to sell at that price to you, so you have to wait for a period of time. So whenever the price actually hit $2,500 in the future, the trade will be automatically executed by the computer. There are two types of price contingent orders. One is limit order. The second one is stop order. The limit order and stop orders can be very tricky. So before I introduce the definition, I want you to look at the example of the Facebook stock. Now suppose the Facebook stock is currently trading at $200. So $200 is the market price. If you place a market order, it will be executed at $200. Okay, so let's first look at the limit orders. We look at the limit buy order first. So when you want to buy Facebook stock, but you do not want to pay $200 market price, you can place a limit buy order at a price lower than the market price, say $190. So here you're hoping to buy at a cheaper price than the market price. Then you wait. In the future, if the price fall below or hit $190, your order will be automatically executed and you purchase the Facebook at $190. Okay, so we'll look at the diagonal. The limit sell order. The limit sell order is when you want to sell higher than the market price. So now the market price is $200. You want to sell higher than $200. You can place a limit sell order at $210, for example. Okay, which means you wait because the current price is $200. Your order will not be executed at all. So you'll wait a little bit longer, hoping in the future the stock price will go up to at least $210, and then your order will be executed at 210. So you can sell your Facebook at 210. So you really hope you can sell at a higher price than the market price. So that is when you place the limit sell order. Okay. Now let's look at the stop orders. When you place the stop orders, we look at stop buy orders. Okay? The market price is $200. You are hoping you can buy at a lower price, but the price seems to going up and up and up. So you place a stop buy order whenever the price rises above $210, which is higher than the current market price $200, to prevent the loss from further increase in the stock price. Because if you really want to buy Facebook and the stock price continue to increase to 210, 220, even to 300, right? So prevent the further loss. You will say, okay, at 210, no matter what, I'm going to purchase the Facebook stock. So that is when you place the stop buy order to prevent the loss from future price increase. Again, we look at the diagonal. The stop loss sell order. When you want to sell Facebook stock, well, you feel like the stock price is dropping, it's going down. Well, you will place a stop loss sell order on the price. Say, whenever the stock price fall below or hit $190, sell it or stop the further loss from stock price decrease in the future. So now let's summarize. Look at the table on the upper right-hand side. The limit buy order and stop loss sell orders will be executed whenever the price falls below the limit. The stop buy orders and the limit sell orders will be executed whenever the price rises above the limit. There are two types of trading cost. The first one is commission, which is the fee you pay to the broker for making the transaction happen. Remember the difference between the broker and the dealer? The broker takes the commission whenever the deal is done. If the deal did not go through, the broker will not receive any commission. Well, the second trading cost is called the spread, the bid-ask spread, which is the cost of trading with the dealers. Recall the bid price is the price the dealer is willing to buy from you, while the asked price is the price the dealer will sell to you. The spread, the bid-ask spread, or ask minus bid price, is the profit for the dealer. And sometimes you have to pay a combination of the commission and the spreads when both brokers and dealers helped you in the deal. Now I want to introduce the important concept of buying on margin. Basically, whenever we talk about margin, we're talking about borrow money to invest. So buying on margin means investor can receive a short-term loan from the broker or borrow money from the broker in order to buy stocks on margin. The percentage margin is your own money divided by the value of the stock. For example, if you have $2,000 and you want to buy one share of Amazon, which is currently trading at $3,000 per share, and you are $1,000 short, what you can do is you can borrow $1,000 from your broker, combined with your $2,000 in your own bank. Now you have $3,000 and you can purchase one share of Amazon. So what is your percentage margin? That is your own money, $2,000, divided by the value of the stock, which is $3,000. So the percentage margin is roughly around 67%. The initial margin requirement is set by the Fed, which is 50%. Your initial margin in the Amazon example is 67%, which is higher than the required margin 50%, so you are good to go. Buying a margin is considered as a very high risk of investment. I'm going to give you some numeric example to show you why. So before we look at the example, let's take a look at important concepts. The first one is the initial margin, which is 50% set by the Fed. It says you can borrow up to 50% of the stock value. Maintenance margin means once you set up the margin position, you have to keep at least some level of the margin, which is the maintenance margin. Most of the time, the maintenance margin is lower than the initial margin, say 40%, which means if the maintenance margin is 40%, at any given date, your own equity versus the stock value cannot be lower than 40%. When that ratio drops below 40% on any given day, you will receive a margin call from your broker. So the margin call is either a physical phone call or a notification from your broker, which means you need to put up additional money into the account to make sure to restore the margin to at least the maintenance margin, say 40% in our example. Now let's look at the numeric example of margin purchase. The initial setup is initial margin 50%, maintenance margin 40%. On day one, you want to set up the margin purchase position. You want to purchase 1,000 shares of the stock, which is trading at $10 each, which means you need $10,000 to set up the position. But the problem is you only have $5,000. What you can do is you can borrow another $5,000 from your broker. So the $5,000 you have is in the green box, and the $5,000 you borrow from the broker, which has to be returned when you close the position, is in the blue box. So that's what happens in day one. You set up the position and initial margin is 50%, which is your own money, $5,000, divided by the stock value, which is $10,000, exactly 50%. So you are good to go. Well, on the second day, the stock price changed from $10 to $15. Let's see what happens to your margin account. Well, the total stock value is $15 times 1,000 shares, $15,000. Well, minus the $5,000 you borrowed from the broker, which you have to return, you have $10,000 left all to yourself, which is perfect, right? You made a profit. Well, what is the maintenance margin on day two? The maintenance margin is again your own money, $10,000, divided by the stock value, $15,000, which is way above 40%. So you are good to go. Now we move on to day three. Well, day three is not a lucky day for you. The stock price dropped to $7. Let's see what happens in your margin account. When the stock price dropped to $7, the total stock value will be 7 times 1,000 shares, $7,000. Minus the $5,000 you have to return to the broker, you only have $2,000 left. That is your own money. Well, let's calculate the day three margin, which is your own money, $2,000, divided by the stock value, $7,000, which is below 40% maintenance margin requirement. At this level, your broker will give you a call or notification asking you to put additional money in this account. Now we're going to look at an even more complicated example. Please follow me. Alright, so now you want to buy $10,000 worth of stock, $10 per share, and you want to purchase 1,000 shares. You have $6,000 to go, which means you have to borrow $4,000 from your broker. So let's calculate initial margin, which is your own money divided by the value of the stock. $6,000 divided by $10,000, which is 60%, which is higher than the 50% required by the Fed. So you're good to go. Okay, so what happened to the stock when the stock price changed? Okay, now suppose on the very second day, the value of the stock goes down from $10 to $6 per share, which means because you purchased 1,000 shares, the total stock value will drop from $10 to $6,000. You lose $4,000. Let's calculate the new margin. Now your own fund is, you start with $6,000. Now you lose $4,000. Your own money is only $2,000 divided by the total value of the stocks, $6,000. The new margin is 33%. If the maintenance margin is 40%, you are below that level, means you will get a margin call from your broker. It could be a call, it could be an email notification, or any electronic notification. What you can do is you have two choices. The first one is you have to add new money to your account to restore the percentage margin to 40%. So let's see how much money you need to put into this account to make sure the margin go back to 40%. Okay. Basically means you need to put additional $400 in this account. Let's see. Before you put the $400, your own money is $2,000. After you put in additional $400, your own money becomes $2,400 divided by the stock value, $6,000, which is 40%, right? You need exactly $400. So the broker will call you and you will put additional $400 in your margin account. So the margin account will be kept alive for another day. So this daily calculation will go on until you close the position. So every single day, your broker will calculate the maintenance margin and compare that margin to 40% required maintenance margin. Whenever it's below 40%, you need to put additional new money. Okay, so you may question, okay, what if I do not have additional $400? What shall we do? Well, if you do not have enough money to put in this account, if you don't have $400, the broker will sell your existing stocks from the account to restore the margin to 40%. How will they do it? Now suppose the broker will sell X shares to restore the margin to 40%. Let's put in all the numbers in the formula. You do not have additional fund, so your own money is still $2,000 divided by the total stock value. So the stock value is $6 per share, and you originally purchased 1,000 shares, minus the X shares the broker will sell. Set the ratio to 40%, which is the required maintenance margin. Then you can back out X, which is roughly around 167 shares. So now you have two options. Whenever the new margin is below the maintenance margin, you can either add additional cash to the account, or if you don't have money to put in that account anymore, your broker will sell your stocks to restore the margin to 40%. So now let's look at another example. X Corporation currently trading at $70 per share. Initial margin 50%, maintenance margin 40%, and you just purchased 1,000 shares. So the initial balance sheet looks like the total stock value is 70 times 1,000 shares, $70,000. Well, because the initial margin is 50%, means half of the money is borrowed. So $35,000 is borrowed, and you paid $35,000 in this account. When the stock price falls to $60 per share, the new balance sheets look like this. On the left-hand side, the stock's worth $60,000, which is $60 per share times 1,000 shares you purchased. The borrowed amount remains the same, $35,000, which means the equity took the loss of $10,000, so the equity dropped to $25,000. Let's calculate the new margin, which is your own money divided by the stock value. Now your own money is $25,000 equity divided by the stock value $60,000, which is 41%, which is above 40% maintenance margin, so you're good. But let's take a look at what is your rate of return. What is the percentage loss? Okay. So from $70 to $60, you lost $10 per share, and you totally have 1,000 shares. So totally, you had a $10,000 loss divided by your initial investment, which is your own money, the money you actually put down, which is $35,000. The loss is negative 29%. Now imagine if you did not borrow money from your broker, which means you just use whatever the money you have, which is $35,000. You can only purchase 500 shares, half of the shares, right? Okay, so if you did not borrow, what is the rate of return? That will be $10 loss per share times 500 shares you just borrowed, divided by your initial investment, which is $35,000, and the total loss is just 14%. So negative 29% versus negative 14%. These numbers showed you buying on margin is very risky. It will magnify the returns, but at the same time, it will also magnify the loss. In the previous slides, when the stock price dropped from $70 to $60, your new margin is 41%, which is above 40% maintenance margin, so you're fine. But if the stock price continues to drop, below which level you will receive a margin call and you have to put in additional money. Let's use the formula of margin again, which is your own money divided by the stock value. Now your own money will be 1,000 shares times whatever the stock price you're looking for minus $35,000 you borrowed from the broker. So that is your own money divided by the stock value, which is 1,000 shares times the stock price you're looking for. Set the ratio to 40%. You can back out the price, which is $58.33. When the stock price continues to drop below this level, you will receive a margin call. Now assume you purchased 200 shares of XYZ on margin at $70 per share from your broker. If the initial margin requirement by your broker is 55%, how much did you borrow from the broker? Okay, here the broker set the initial margin at 55%. As long as the initial margin is 50%, you are good. So any initial margin that is set above 50%, that is good. The brokerage firm can never set a margin below 50%, which is the minimum requirement of the Fed. Okay, so the answer is the total stock position, 200 shares times $70 per share, minus 1 minus 55%. So 45% is the money you borrow from the broker, which is E, $6,300. Now you purchased 100 shares of ABC stocks on margin at $70 per share, which means the total position will cost $70,000. Initial margin is 50%, means 50% of the $70,000, $35,000 is borrowed from your broker. If the maintenance margin is 30%, at what price level you will get a margin call? Okay, because the initial margin is 50%, which means you borrowed 50% times $70,000, the stock value. You borrowed $3,500. Now use the margin formula. Own money divided by the total value of the stock. Set that ratio to 30% maintenance margin. Okay, so your own money will be 100 shares times whatever the price you're looking for minus the money you borrowed, $3,500, divided by the stock value, which is 100 shares times the stock price P. Set the ratio to 30%. You can back out the price level, which is $50. Now we are going to introduce the idea of short sales. When you think the stock price will go up, you want to use the margin purchase because you want to use margin purchase to magnify your returns. But what if you expect the stock price will go down? How do you make a profits? Then you will use short sales. So the mechanism of the short sales is, today you borrow one share of the stock through a dealer, sell it immediately, and deposit the proceeds and whatever the margin requirement in the account. Then you wait until the stock falls, and then you can close out the position, buying the stock at a lower decreased price, and then return the shares to the broker. Then you close the position. When you think the stock price will drop, what you can do is you can short sell the stock to make a profit. So let's look at the procedures of the short sales. At stage 1, short sellers borrow 100 shares. The current market price per share is $10. Okay, so now you're looking at the stock. The current market price is $10. You think that is too much. The stock price is not worth $10. In the future, the price will definitely drop. So what you can do is you want to sell the stock at a higher price, $10. And then in the future, you want to buy it back at a cheaper price. The only problem is you don't really physically have the shares to sell. What you can do is you can borrow 100 physical shares from your brokers. That is in stage 1, you borrow the shares. In stage 2, once you borrow the shares, you sell it immediately at the market price. In this example, you sell immediately the 100 shares you borrowed at the market price, $10 each. The proceeds from the sale is 100 times $10, $1,000. Then you wait. In stage 3, when the stock price drops to $8, now suppose you're right, the stock price indeed dropped to $8. What you want to do is you want to close the position by buying back the 100 shares at $8 each. So how much it cost? 8 times 100. It only costs you $800 to buy back 100 shares. Then we move on to stage 4. You made a profit, right? Because you bought the stock at $800 in a future date, while you already sold the stock for $1,000 when you set up the position. In stage 5, the short seller will return the 100 shares to the broker to complete the position or close the position. The picture in the bottom shows you when the stock price falls, you will make a profit. But what if you were wrong? The stock price goes up, then you will make a loss, because if the stock price continue to go up, say $12, $15, $20, $100, then you may never be able to buy them back and return the shares to the brokers anymore. So short sales is a very, very risky position. To summarize, if you think a particular stock price will fall in the future, what you want to do is short the stock. So today, you borrow the shares from the broker and sell them in the market at a higher price. Then you hope in the next period, the stock price will drop to a lower level. Then you can buy them back at a lower price to cover your short position. But there are things to think about. First of all, there is margin requirements. I'm going to show you some numeric example later, and the margin calls. The bottom line here is it is a very, very risky position because you have unlimited downside. In the previous picture I showed you, the stock price can go up to the sky. You have no control. There's no ceiling for the stock price can go up, right? Which means you will have unlimited downside risk. So now let's look at a numeric example of the short sales. You want to short sell Z Corporation 100 shares. Initial margin 50%, maintenance margin 30%, and initial price of the Z Corporation is $100. So basically you think the Z Corporation is not worth $100. You're hoping in the future the stock price will drop. So what you want to do is you want to borrow 100 physical shares from your broker and then sell it immediately at the market price, $100. So the sales proceed or the proceed from this short sale is $10,000, which is 100 shares times $100 per share. So totally you got $10,000 from selling the borrowed shares. Well, when you borrow 100 shares from your broker will require you to put some money in the margin. Again, the initial margin is 50%. So the total stock you sold, $10,000. 50% of that is $5,000, which means in order to borrow 100 shares, which is $10,000 worth of stock, you need to have at least 50% of that money, which is $5,000. You need to physically put $5,000 from your bank to this margin account. So on day one, when you set up the short sale position, your margin account looked like this. You will totally have $15,000 in your account. $10,000 from the sales of the 100 shares you borrowed, and $5,000 from your own bank account, which is set up there or put there as a safety money, okay, like a safety deposit. You can think in that way, right? In case something happens to your position, at least you have some money to pay back the broker. Otherwise, the broker will be exposed to too much risk. Okay? So now you will own 100 shares to the broker because you already sold it. You're hoping in the future the stock price will drop and you will buy 100 shares at a lower price and then return it to the broker. Well, it turned out to be a wishful thinking. The stock price did not drop. On the contrary, it goes up to $110. Let's see what happens in your margin account. Remember the sales from selling the 100 shares of stocks, you got $10,000, and you also put $5,000 in the margin account. Now the stock owned is $110 times 100 shares. Now you totally own $11,000. So the net equity is $4,000 because each share you lost $10 and there are totally 100 shares, which is deducted from your own money $5,000 in that margin account. So your net equity is $4,000 divided by the total market value of the stock, which is $11,000. So the new margin becomes 36%. So let's calculate the rate of return on this investment. Each share you lost $10 and there are 100 shares. So totally you lost $1,000. Divided by your initial investment, which is the $5,000 from your bank put in that margin account to satisfy the 50% initial margin, right? So your initial investment is $5,000. The rate of return is negative 20%. So you lost 20%. Again, short sales magnify your returns, but at the same time, it also magnifies the loss. If you did not short sell, look at the stock price. From $100 to $110, the stock price increased by 10%, while your loss is 20%. So short sales magnify the returns and the loss. In this case, it doubled your loss. It is a very risky position. Now we ask the question, if the stock price continue to go up, at what level your broker will give you this margin call? Okay, so we will check what is the maintenance margin required by the broker. Oh, it is 30%. Okay, so we will set the new margin to 30%. The new margin is again your own money divided by the stock value. So we look at the denominator first, which is simple. The stock value, the market value of the stock, which is 100 shares times whatever the stock price level you are looking for, P. The numerator is the amount of money that belongs to you, your own money. So remember, initially you have $15,000 in your account, right? So that is the money sitting in your account in day one. Minus, because you have to return 100 shares of stocks, so minus the money you pay for the stocks, which is 100 shares times the price level you are looking for. So $15,000 already sitting in your account, minus the money you will have to pay to buy back the stocks, which is 100 shares times P. Set the ratio to 30%. You back out the price level, which is $115. So whenever the stock price goes above $115, your broker will give you a margin call.